Is the stock market overpriced? That's one of the things we will be discussing today in the Investing Mastermind Podcast. My name is Signe Lundholt.
And I'm Michelle Markey.
Today, we're going to look at the stock market as a whole. Usually, as Warren Buffett-style investors, we zoom all the way and narrow our search into one company and don't necessarily look at the macro picture of how the stock market is doing. But today, we're going to talk and shares the information we have about how you as an investor can take a look at the overall American stock market and determine, is the market overvalued or are stocks trading at a discount? And these days we hear many different things, like some news media outlets are saying stocks are still cheap, and others are saying, oh, we're in a bull market now, stocks are becoming expensive again. So for us as individual investors, it can be very difficult to find out, is stocks really overpriced or aren't they? So today, Michelle and I, we're going to talk about two indicators that tracks the stock market, what we call Buffett Indicator and Shiller's PE ratio. Michelle, is this something that you would look at every day or even every week, every month? Like, is this a tool that you use in your investing practice?
Well, I learned about these tools from Phil Town and Danielle Town. They've brought it up a lot in their podcast and the book that they wrote, Invested. And it's sort of interesting to think about every now and then. So I don't consult these figures very often. It's just sort of, just to be kind of taking a quick temperature gauge of the stock market, just to see kind of like how it's sort of feeling. Like this year, it's felt a little bit frothy because markets were somewhat up from the end of last year when a lot of the big tech was beaten down toward the third and fourth quarter of 2022. And a lot of them have gone up a lot this year, and it's carried the major indices like the S&P 500 up significantly again. So just when you thought like, oh, you can't just expect to get 15% returns every year, it's kind of happening again now, where if you had invested at the end of last year, maybe you could be up about 15% now, but that might be lulling people into this state of complacency. And so if you do take a quick look at some of these figures, you might realize, oh, actually, it's not quite that on sale. It's a little bit overvalued according to some of these websites. Like if we were to look at one of them that talks about the Buffett Indicator, the currentmarketvaluation.com website, and they will show you that the Buffett Indicator is reflecting an overall stock market that's considered overvalued. And to explain what the Buffett Indicator is, that means it's a Wilshire 5,000 market cap. So an index of all the 5,000 major companies that are on this Wilshire 5,000 index divided by the US gross domestic product, or GDP. And when you do that, you get a market that's still considered overvalued. So based on that, it seems that if the stock market's about $49 trillion and the GDP is only 27 trillion, the market is still overvalued by 182%. And there's another indicator of this that you could look more officially at one of the Fed's websites that goes through a lot of stats, and it's known as FRED, the St. Louis Federal Reserve. And they also have the Wilshire 5,000 over GDP. And the market is not as bad as it was compared to more recently. Like there have been recent quarters where it was kind of like at the all-time high in the end of 2021, where the market was overvalued at about 250%. And then in the end of 2022, a year later, it went down to only being overvalued by 190%. So it went down by like 60%. But in spite of that, it's kind of ticked up again to being now overvalued by 196%. And to put that in perspective, Buffett would consider the market usually fully valued at 100 to 120%. So it's only on sale if it's at 60 to 80%. But maybe those were the good old days. Maybe we've hit a new plateau of just this sort of stock market purgatory where things don't ever get cheap anymore on the whole. And now you have to look for the needles in the haystack to find companies that actually could be on sale and kind of ignore what the overall market could be doing, since that could be just dulling your sensitivity to looking for the gems in the rough. So with some of that, I knew I threw out a lot of stats to start with, but what are your thoughts, Signe, about what some of this could be meaning?
It could be, very overwhelming to hear all about these things. So to just break it down, what Buffett says is that there's a relationship between the stock market value and the health of the American economy, right? So the relationship between the stock market value, that is this Wilshire 5,000 index, which is 5,000 publicly traded companies in the United States. So it's a very, very broad index. You have almost all the American publicly traded companies in there. And we take that, the Wilshire 5,000 market index, and we take that and we compare it with this gross domestic product, which is, the total income of a country, you could say. So what Buffett says with this is that there is a relationship with how well the stock market is doing and the health of the American economy. And as Michelle mentioned here, if it's over 100, that's when Buffett says then stocks are expensive. And if it's lower than 100, then, it's undervalued. I believe that Phil Town says that when the Wilshire is 70% of GDP, which, if you use that graph, is 0.7 on that graph from Fred Lewis that you mentioned, Michelle, then it's a good time to buy stocks in general. But when it's over 100, then it becomes overpriced. So what Buffett likes about this is that it's a fundamental indicator. It's real money and real earnings that we're showing here. It's not just some random number that you can find on other indicators. That's why Buffett likes this one. You also opened up to talk a little bit more about another index. Should we go there, or do you have more to say about the Buffett indicator before we move to Shiller PE?
Well, all I wanted to also mention with the Buffett indicator is that, like you were saying, it's a broad measure. It doesn't mean that there isn't opportunity in the stock market. So you could be looking at it and just giving up and just saying, well, if it's overvalued, then what's the point of investing right now? Especially if you are a Buffett style investor like we are, then it might feel a little bit discouraging to be like, well, as a broad stroke, it's just too expensive. So maybe you might want to look for other places where you're getting yield. Like there's apparently been $36 billion of money that went into money market mutual funds. So if you are not sure if you want to be in the stock market, some people might be getting, a comfortable high 4%, 5% or so from the money market mutual funds, which could be based on US Treasury bonds, which have also been kind of reaching some of their highest yields in a very long time, like 16 years. So if you take advantage of some of that, you could be getting a somewhat safe return. So some people could be weighing these factors. And I'm not saying there's one right way to go about this. It has to depend on your investing temperament. But I wouldn't just make a final judgment about how you invest based on just looking at the Buffett indicator or the next one we're about to talk to, the Shiller price to earnings ratio. So
yeah, and I think
keep that in mind.
Yeah, that's a super important point you made there, Michelle. So thank you so much for just highlighting this. Don't take this as us saying now you should invest or you shouldn't invest. It's a way for you to just, have another indicator of how are we doing these days? Don't invest in something or don't invest in something because of what you hear here. This is just, for you to become more, knowledgeable about the stock market. That's why we're providing this information. Sorry for interrupting now. Go ahead.
Oh, yeah, but no worries. I mean, I just want to also say we can segue into talking about Shiller PE. And I started mentioning what it meant, like the full name of it. And there's this person named Robert Shiller who is credited with coming up with this ratio. He's an economist. And there's also, if you may have heard of the Shiller Home Price Index, I believe. So
yeah, and he's an author too. If you would like to read or listen to some of his book, he's the author behind Irrational Exuberance, also about the stock market. And that's actually a great book. Lots of great quotes in there, quite advanced, but maybe something for your bookshelf at some point.
Yeah, and he seems respected because he won a Nobel Prize in economic science. So, he may know what he's kind of talking about, but even though it's sort of useful to kind of consider it, in a way, it's an index of looking at the past in this Shiller PE. Like when I say index, I mean as a statistical measure of some of the market's trends. So oftentimes you may have heard in your own investing experiences, some people talk about the PE ratio or the price to earnings ratio. And the Shiller is an adjusted ratio where it's an average inflation adjusted earnings from the previous 10 years. That's also known as the cyclically adjusted PE ratio, or CAPE, and AKA Shiller PE. So some people might say the stock market's historical average PE was maybe around 16 or so. And the Shiller is showing that the average PE was 17. So compared to that, if the average was, let's say, 17 right now, what you're kind of expecting is that you're paying 17x for the earnings of a stock. So if, let's say, a stock's earnings was 5, you do 5 times 17, and maybe you're paying $85 for the stock. So that's kind of what you think of as price to earnings. And so if 17 were average, right now, the Shiller PE is at 30, which came down from about 40 in 2021, but it's still kind of double the average or mean of 17. So that, in addition to the Buffett Indicator, suggests that the market is still overvalued.
Yeah, and as a beginner investor, you might have seen this PE ratio. For example, if you have an iPhone, there's the Stocks app. And if you look in the Stocks app and open for a given company, you can see this P/E ratio in there. And it's a way for investors to determine the stock market price versus the company's actual value per share. Very simplified. But what I can say is if the PE of a company is high, then you're paying a very high price for your wonderful company. Now we're currently talking in Zoom where we record this. And for example, if you look at the Zoom PE ratio, it's in the thousands. It is, as far as I remember, it's really, really high compared to, for example, as Michelle says, the average is 17. So the Shiller PE actually tracks back many, many years. And what we can see there is the lowest PE was back in December 1920, where it was just under 5. And the maximum was in December 1999, where the Shiller PE reached 44.19. And that was right before the 2000 internet crash. And usually this Shiller PE, it's actually quite uncommon for stocks to go that high. So first time was in 1929. And then the second time was in 2000. And the third time is right now. And it's been like that for years. So there's only been 2 times in history in the last 100 years. And what happened the other 2 times was that the stock market crashed. So 1929, you might have heard about it, the big crash, and 2000 is known as the IT bubble. So yeah, it's definitely food for thought. You said, Michelle, well, we don't know. We can't predict what will happen. Maybe that's just the way the world is right now, with more people coming into the stock market, robo-advisors, everything. That could be a new reality. We don't know. All we know is it's only been this high twice in the past. It's quite uncommon territory that we're in right now, and has been for a while. It did dip a bit, but now we're back up to 30. So what does it mean? It's difficult to know.
Yeah. So as a broad stroke, it's just interesting to consider, and it's definitely a warning sign. Like, It's giving people maybe some pause, and that could be part of why a lot of people could be leaving the stock market and putting their money into what they perceive as safer assets like bonds or like money market funds for now. And then maybe they'll come back into the stock market later. But you can see that if you invested in the stock market right now at a 30 PE, you're only expecting a 3.3% return because you just divide 30 into 1 and you get 3.3%. That's what you're expecting to get as your return from the overall S&P 500 index fund, let's say. And even though that hasn't been the case year to date, but because the market overall is considered somewhat overvalued, you shouldn't expect to be getting 15% because it's not at 15% PE. That's not really realistic right now, even though the market could be defying expectations at the moment, but who knows how long that will last. And compared to the historical average of 17, that would be a more reasonable 5.9%. But why kind of, expect that right now? It's not even at 17 when you could be getting, like I mentioned earlier, around 5% in a high yield savings account if you're in the US. I know not everywhere offers such a generous yield right now because the Fed has been hiking the interest rate over the last year. And so like a lot of us are getting kind of lucky getting higher yields in just a normal savings account, but who knows how long that will last either. A lot of people have been kind of saying, where is our recession? We were kind of promised a recession and we haven't gotten it yet. So like kind of, it's sort of like a twilight zone we're entering. Like yields are high, but people are still more employed. And what the Federal Reserve is trying to do is pump the brakes on the economy by raising the interest rate. So it makes borrowing costs go up. Like if you're trying to get a house and you need a mortgage, you could be getting 7% interest rates right now, which is a little painful because just a few years ago, you could get a nice small 2 to 3% and inflation was raging. So you were actually making money if you got a mortgage or a loan out in 2020 or 2021. But now that the borrowing rates are high, it's not great for people who need debt, but it's great for savers. So if you're a saver out there, you're kind of enjoying just having your money sitting in a boring old bank account and earning some yield for now. So
well, it's also nice actually to get that tax break from the, the interest on your house. So that's another way to actually also, look on the bright side is if you own your own house, then, you might actually not have to pay as much tax because of, the high interest rates.
So yeah, I mean, that helps to offset some of it, but I know a lot of people are taking pause at it because it also means your monthly payments went up so much more. Like the difference between having only a 3% mortgage rate compared to 7%, you're paying more monthly. So it feels more painful if you have to shell that out right now.
100%. So what Michelle is also saying, just to go back to some of the things you said, when we look at probabilities, so the probability of a stock with a low PE ratio, a quality company, there's other things you need to look into also, not just only PE, but a quality company with a really, really low PE ratio, there's a probability there that you're going to get a bigger return the next couple of years versus a company with a high PE ratio. The probability is lower. And we're not saying that, a company with a high PE ratio would necessarily not yield 15%. That could happen. It's just about probability. So one exercise you could do after listening to this show is you could open an app or a website that shows the PE ratio, Yahoo Finance, or, the stocks app on your phone, and then look at different PE ratios of companies to just see how either low or high they are. Don't invest in the stock just because the PE is low, because it could have a terrible business. So you do need to listen to our show and some of the other episodes where we walk you through what is a quality company. And you can go back and listen to some of the previous episodes for that. It's just a fun little exercise. Like I mentioned, Zoom, I had to look it up. The PE ratio, 3,300.
Wow.
14. Yeah. Of a PE ratio. And we're talking about, the average is 17. Would you invest in something like that when it's that high? you're taking a risk. It could continue to go up. Who knows? But it's risky.
Well, and that also means that that's how long you're expecting to get your money back in 3,000 years by investing in Zoom, because their earnings are so low and the price is so high that, okay, like if you can wait 3,000 years, it's okay. You'll get your money back by then.
And I was actually looking into a Danish company recently, and I'm not going to share the name here because I don't know if it's a good quality company. So I don't want to say anything about that business. But their PE was 1.45, and it's a company that existed for many years. It's well known here, and I just thought that's really, really interesting. The stock price of that company is very, very high, so that means that they might not have a whole lot of shares outstanding, and that kind of keeps the stock price high, and not a lot of people then have the funds to buy one share of that business. They would have to maybe save a lot to do that. It's not one of those companies that are easy to get to, but the PE is really, really low. What you hear me say here is also just because the stock is cheap or that the stock is expensive doesn't say anything about the earnings of the company. Those are completely different. And that's where, a lot of people think, okay, so the price I see right now on the graph, that's what the company is worth. No, they could be doing even better, or they could be doing worse than what you see. And that's why it's so important to get educated on this, because not a whole lot of individual investors knows about this. So they just buy whatever, the price is today, when they could be doing things to actually make sure that there's a higher probability that you would get a return on those hard-earned money that you put into that stock.
And exactly to your point, reflecting on that, like say you found a company that only has a PE of 1.5. Imagine you could maybe get your money back in 1.5 years. That could be phenomenal. Or that could be what they call sometimes a value trap, that it's too cheap to be true. And even if you put your money in it, it may not realize the real value. It may never get to the real value. So it could be a double-edged sword, but it could be potentially something to look into, especially if in that example, it sounds like a very specific kind of investor that's invested in that type of company with a stock price really high. Kind of reminds me of Berkshire Hathaway A share that's like over $500,000 a share. Yeah. Maybe, if you can afford that sticker price, it's maybe interesting. Like instead of buying a house, you buy one share of Berkshire and, you kind of sit on that for a while. Like some people think of their houses as their savings, which may or may not be a good idea. But if you think about some of that, investing in a stock is not like when you're buying groceries. Like when we see the price of hamburger meat in the store, that's like, a going price. Like it could be $5 a pound, it could be $2 a pound, and you can compare, from store to store what is reasonable to pay for ground beef. But it's not like that with the stock market. Just because you see Berkshire Hathaway at $500,000 doesn't mean it's too expensive. In fact, some other stock, like let's say Apple at $170 a share, that could be way too expensive. And even though it seems on the surface like, oh, $170 is cheap compared to $500,000, but you don't judge it based on the price alone. You judge it based on the underlying business fundamentals and also the earnings and so many factors that you can learn from in Signe's course. If you visit investionista.com, I'm just going to give you that plug there, my friend. But yeah, there's so many factors you can learn about so that you can make an informed investment decision about what really makes sense.
Yeah. And if you found this interesting, and that's what I see with, some of the mentees, I call my clients mentees, right? So if you found this interesting, please do feel free to write a review or share this podcast with your friends and connections, because this is really an eye-opener to so many people about this PE. And maybe someone in your network could actually benefit from listening to this episode. So feel free to share, to review us, to rate us on your podcast app, and share us on social media. We're coming to an end of the show today. We will be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.